Let's start again. Okay. All right. It is November 8th, 2022, and I'm here to answer any questions that you guys have or want to go over in preparation for your exam tomorrow. So in the chat, I already see go over contra revenue accounts. I can do that. And what goes into comprehensive income? List of things to watch out for. And what do you mean by comprehensive income?
I think so. I didn't know exactly like what things to because basically the comprehensive income is discluded from the income statement, right?
Yes.
So what types of things would be on the comprehensive income statement that you wouldn't want to put on an income statement?
So the short answer right now is you're not responsible for that for the exam, but I'm happy to answer that question. So companies make an income statement according to the rules of generally accepted accounting principles. And they come down, you've got sales, you've got cost of goods sold, you've got gross margin, you've got operating expenses, you've got operating income, and then you've got the other revenue and expenses. And then you've got income before tax, then you've got income tax expense, and then you've got net income. A really good picture of that is in the optional course pack. And I'm just going to bring that up real quick, just so you see. Oops, back up. And there's one in your textbook too, but I also put it in the course pack. Talk to me. Not responding. Okay, I'm going to be really slow today. All right. So it has a whole list. There we go. A whole list of this in the course pack. And this page down. Here we go. All right. Are you able to see the Jennifer Company statements or no? Yes. Okay. Thank you.
Yeah, it's a little small, but it can definitely see it. There we go. That's better.
All right. So here's an example, and it's on page 80 of your course pack. There's a good example. And you all have access to that. And this is called the multi-step income statement. And you need to know how to do it. It's in your practice exam, and it's also here. And it's also in your chapter 5. And so we use the multi-step income statement extensively, and everything pink here is a subtotal. And then this was also in my PowerPoint slides. Okay, so sales revenue, we call this gross sales, 250. And these are contra revenue accounts, which James, you'd asked about. And if you go to Target or Walmart, you buy something and then you take it back. They could just reduce the sales account, but a lot of companies like to track their returns. So instead of debiting cash and crediting sales, they'll debit the return, debit sales returns and allowances, and then credit cash if they give the customer money back. Okay. So what this creates is you see kind of a trail of, oh, we had sales of 250, but our customers brought back 8,000. That's kind of a low number relative to 250. Other businesses have much higher returns. At one time, Nordstrom would take anything back, including merchandise they did not sell. I don't know that they still do that. Sales discounts are when a company sells to another company and they give them a benefit discount if they pay faster than 30 days. So you'll see some language there in the terms or in an accounting prompt. Company A sold to company B. The terms were 210 net 30, and it's written like 2-/10 net 30. And I just put that in the chat. And what that means is you pay in 30 days. That's when this bill is due. But if you pay in 10 days, I'll give you 2% discount. So that's all that's saying. Okay. So those are contra revenue. We want that information. Typically, a merchandise company wants that information as opposed to just reducing sales. Okay. All right.
I
So
think
here's
I have another question. So the contra revenue accounts are always debit.
contra revenue. Contra means opposite,
Yes.
contrary. So if it's a revenue account, the normal balance is credit. So
Yes.
contra revenue would be debit. Yes.
Gotcha. Cool. Awesome.
Okay. So anyway, you asked about comprehensive. So this is the required format, net income that I told you. All right. And wait a minute, that's not right. Let's go back. I'm on the other page. Here we go, multi-step. Yeah, okay. So here we have operating expenses, total operating expenses. Income from operations is the difference between gross margin and operating expenses. Then we have these other revenue and gains, other expenses and losses, and you have to know which one's bigger because we're going to add the revenue and we're going to subtract the expenses. So in this case, the revenue was bigger. So we're going to add it to get to 20978, right? Then we calculate income tax, and the problem gave us that income tax was a certain percent, I think 20%. And then we get to net income. That's what's required. That's what's required from generally accepted accounting principles. Comprehensive income says, what if that stock investment that you owned has lost money? Like a lot of stock has lost a lot of money right now. What if you sold the stock today? How much would that loss be? And let's deduct it from net income. Or how much would that gain be? And we'll add it to net income. It's kind of a what if comprehensive income is. What if you sold your stock and took a loss? What if you sold your stock and took a gain? And so any kind of an investment account, it's called an unrealized gain or loss. Hang on, let me tell my program director, Sheila. Office hours. She just called me. Okay. All right. All right. So that's that question that you asked. And do we need to know quality earnings ratio? I'm not sure. Again, what do you mean by that?
I have a question.
Hang on, Alexander. We got another question, but can you
Okay.
put it in the chat real quick? Or no, just
Yeah.
ask it out loud, Alex.
Oh, I was just gonna worry. You just mentioned something about comprehensive income. Do we have to worry about that for the test?
No, not for this exam. You need to know it in
Okay.
theory for quiz and stuff, but yeah,
Okay. Thank you. Sorry.
no worries.
For the quality earnings ratio, it was one of the definitions in our textbook. For number 5 is a measure used to indicate the extent to which a company's earnings provide a full and transparent depiction of its performance, computed as net cash provided by operating activities divided by net income.
Got it. Okay. No, we're going to hit that in chapter 13 in accounting 202. So,
Gotcha. Good to know.
Yeah.
Sweet.
Yeah. All right. So going back to the practice exam, let's see. Yep, that's good. All right. So going back to the practice exam, I've got another question. Could you go over practice exam, how to close the entry for retained earnings? So we have a lot of journal entries this chapter. The good news is chapter 6 does not have a lot of journal entries, okay? In fact, it has 0, all right? And chapter 7 has about 4 or 5 journal entries. So this is the bulk of the journal entries. So we've got 7 adjusting, 4 closing, about 7 perpetual, including purchases and sales, and 7 periodic, including purchases and sales, okay? So in the practice exam, we gave you a chart of accounts, but you will not have a chart of accounts on the exam. Okay. All right. So here's an example of the 7 adjusting journal entries. And my advice to you all, and the advice I gave my on-campus students yesterday, was set up your, know that it's an adjusting journal entry, make sure you know what the journal entry is and write it down. Then go back and work on what number to use. How do you calculate the numbers? But if it's a note, if it's an interest rate, the problem is basically telling you, here's our balances. And here's the date of that. Okay. Here's the balances. All the accounts have normal balances. That means if it's an asset account, like equipment, and it says 70,000, we know that's a debit balance. If it's a liability account, like notes payable, we know that's a credit balance because that's its normal balance. Okay. The information has been gathered as of December 31st, 2011. Oops, sorry. And then go right to the instructions. Prepare adjusting journal entries for the 7 items. Do not book the original entry. Okay. Now, all the accounts have normal balance. Okay, so let's go to, they borrowed 20,000. They signed the note on September 1st. This is what the trial balance says. And so what's the journal entry for this? Not dollar amounts, just what is, you got 7 journal entries. Which one is it for this one? And go ahead and put it in the chat or call it out. So what are we doing when we sign a note and we have an interest rate?
Interest, it would be a debit for interest expense and a credit for interest payable.
Great. So that's what I want you guys to do as you approach this exam, do that. Now we've got one for supplies. What's the journal entry for supplies?
It would be supplies expense, supplies.
Correct. Debit supplies expense, credit supplies, reduced supplies. And all of these 7 journal entries, none of them should have cash in them. No cash in adjusting journal entries. It's just one balance sheet account and one income statement account. Equipment, depreciation. What's the journal entry for depreciation?
Depreciation expense, debit, accumulated depreciation, credit.
Great. Okay. And then we bought a policy for insurance. So you're going to get, it's going to be either insurance or a prepaid insurance or prepaid rent. And you can go up and look. And we've got prepaid insurance. So that's a big clue. It's telling you what account to use. And then we're going to have debit insurance expense, credit prepaid insurance. And then here we said lock-free collected 40,000 for consulting services to be performed. That's a future event from December 1st. And they're saying assume an equal amount is earned for each month. So that's pretty straightforward. You're taking money. The original entry was booked December 1st. Now you're doing the adjusting journal entry. Debit, unearned revenue, credit service revenue. And here, this entry is kind of funny, I think, because you already did this entry in chapter 3. We didn't call it an adjusting entry, but it is an adjusting entry. So they performed consulting services. The client will be billed. In other words, we haven't billed them yet, but we already provided the service. Therefore, we can recognize revenue. Debit accounts receivable, credit service revenue. And finally, salaries. Debit salary and wage expense, credit salary and wage payable. Zach wants to know how late I will be responding to emails for help today. My office hours ends at 4, and I have some grading to do tonight. I will probably check email one more time around 6:30. So, okay. All right, so let's look at the closing journal entries. Now,
I had a question.
go ahead, Hamza.
It's for the third one, the previous exercise 1. So I checked the answers, and it said for question 3 that we would debit depreciation expense 7,000 and credit accumulated depreciation 7,000. But it said that we got this on 2009. So 10 years wouldn't it be 3 years?
So we bought it in 2009, good catch. So, but what, it would be 3 years, but it would be, it should be 2009 for 70. Depreciation is booked annually. So we have to assume that it's already been booked for prior years.
The reason was because I didn't also see any balance on accumulated depreciation. Does that mean they paid it or something?
Not at all. It means there's an error up here. It should say, how much should be in there, Hamza?
14,000.
Exactly. Yeah. So we'll fix that. But because it should reflect the other 2 years, right?
Yeah.
You would never, in accounting, you would never book a journal entry for more than the current year. So I'll fix that for the next round, but that's good. All right,
Thank you.
you bet. All right, closing entries. The easiest thing to do is to take a red pencil or some sort of a pencil and draw a line. Oops, it's not gonna work for me. Don't want that. Let's see if I can just draw a free form line. I did it in class yesterday, but didn't seem to want to do it. Nope, forget it. Under retained earnings, essentially everything below retained earnings is part of your 4 journal entries, okay? So the first journal entry for closing is revenue. The second one is to close all the expense accounts. The third one is to close income summary. And the fourth one is to close dividends. So even though dividends is first, we do it last. And it's not the end of the world if you get them out of order, but that's the traditional order. So this is their normal balance. And this is June 30th, and we're saying we want to close this out. This is their normal balance, $4,300 credit for service revenue. It's, if the end of the year is June 30th, we've got to get rid of all the revenue and expense and dividend accounts, because we have just built in our statements, when a company creates statements, they first do the income statement, then the retained earnings statement, and then the balance sheet. And in that retained earnings statement, they show beginning balance plus net income or minus net loss minus dividends equals ending balance. And so we're, by journal entries, we're making that happen. And then after we make the journal entries, we post and show that retained earnings ending balance is now what we said it was on the retained earnings statement. Okay. All right. Sorry, I got something going on with the all right, sorry. We just got asked to do a presentation at a conference, so that's exciting. All right. So first journal entry, if service revenue is normally a debit, I want you to visualize a T account here. So if you've got this T account with service revenue on the right side, $4,300, I want it to be 0. I'm going to debit service revenue and credit this temporary account called income summary. Okay, so let's walk through the solutions here so I can show them to you. Practice exams. Here we go. All right.
Are we gonna have to do descriptions or no?
No descriptions. You do not need descriptions. All right. So here we have service revenue 4,300. And then here's the journal entry. Service revenue, debit 4,300. Income summary credit 4,300. All right. Zach, do you have a question?
Oh, I did, I guess. Yeah, I don't know. I was gonna ask like how much of the exam will be like chapter 4, how much of it will be like chapter 5, like what will it be mainly focused on? But
So stick to the practice exam and I think you'll be okay. I mean, I always tell students if you get the practice exam, you're pretty much, unless you're just really only did it once and you barely remember it, you'll probably for sure get at least a C. You know, and it's, what happens to students is if I rearrange a problem, sometimes students get confused by that because they've only done one example of the problem. They haven't looked at like other homework and things like that. So that's the only thing to be aware of. But the practice exam is a pretty good indicator of the majority of the exam. So, all right. So now we've done entry number 1, entry number 2. We have all these 3 expense accounts, and make sure if you have depreciation expense, we empty that out as well. Sometimes students think we leave depreciation expense. In this case, we didn't have it. So we empty out the expense. Their normal balance is a debit. We're going to credit it. Debit income summary for the total amount. You don't need to go income summary, salary expense, income summary, miscellaneous expense. Just do one journal entry. Okay, so the question is, what do we do with the balance in income summary? So we had a credit to income summary of 4,300. We had a debit of income summary of 4,000. The balance in income summary is what? Put that in the chat or direct message me. What is the balance in income summary after the first 2 journal entries? And don't just do a number, say the number and debit or credit.
I have a
Michaela,
question.
we don't have to do descriptions.
I have a question.
Go ahead.
So do we have to write down the dates for the journal entries when we do them?
Yeah, that will help you actually, especially with perpetual and periodic,
Okay.
because you'll need to know whether they're eligible to take a discount or not, Alex. So James, is just after this after these first two closing entries. What's the balance in income summary?
Sorry, I wanted to rephrase my question. Sorry. For the adjusting entries, do we have to put everything as December 31st, 2011 on the question?
Whatever the
exercise
date,
one?
whatever the date is. Yeah, absolutely. Because
Okay,
it's
so everything has to be December 31st
for
for the
an
adjustments?
adjusting journal entry. It's everything has to be the end of the period date. That could be December 31st.
Okay.
It could be March 31st.
Okay, thank you for that.
Okay. We've got some disagreement here. Okay, that's always good. All right, so I don't know, I wish I had a whiteboard. Theoretically, I have a whiteboard, but let's see if I can make it happen. I don't see it. All right. Okay, so I want you to, let's see if I can do it in here. No, I certainly can't. All right. Just going to use a tablet, a really big marker. Or maybe not that big. Okay. So I strongly recommend you use T accounts on the exam. Okay. I don't know if you can see this. So I've got a T account and it says income summary. Okay. So I'm going to post the first journal entry. It's a credit to income summary. Okay, you guys see it? Credit to income summary. So $4,300. So that's my first closing journal entry. Credit 4,300. My second one is 4,000 debit. Okay, you guys see that? What is my balance in income summary now?
Should be 300 credit.
Yeah, so. make it darker. I'm gonna make it darker. I will tell you, those of you who answered debit, I have done that myself many times. I strongly recommend you make a T account on the side of your exam page to show that. Okay. So after the first two journal entries, we have a 300 credit in income summary. Now think that through. If we have a credit, that is the difference between revenue and expenses. So what that's telling me is we made a $300 net income credit. Okay. Now let's go to journal entry number 3, which is closeout income summary. And I totally recognize that some of this feels redundant. We do it so, oops, didn't want that. We totally do it so we can create a journal entry that shows us net income. And that's what this is doing. We're going to get rid of that $300 balance. That's journal entry number 3. So journal entry number 3, can you see it there? We're debiting income summary, and now we have a balance of 0 in income summary. When you are done with your closing journal entries, and we're not, we have one more to go. When you are done with your closing journal entries, income summary should be 0. All right, let's make a T account for retained earnings. And the first entry is closing entry number 3, because closing entry number 1 and 2 did not impact retained earnings. So can you see that I'm crediting retained earnings? And now it's, oops, you know what I left off here? What did I leave off? I forgot something. When we make a T account, what do we have to have first before we post anything?
Is it the date?
No dates.
The order number.
Nope. It's the beginning balance. Okay. So I need my beginning balance. So let's go back to the trial balance that we have here. What's my beginning balance in retained earnings?
2,200 credit.
Yeah, so I need to put that there, 2,200 credit. So I got that, 2,200 credit. I've got closing entry number 3, credit 300. And now it's time to close this dividend account, 400. So let's close it. We're going to credit dividends to make it go to 0. And we're going to debit retained earnings. And that's closing entry number 4 for 400. So in the chat, tell me what my ending balance in retained earnings is.
Should be 2,500 credit.
Everybody put your guess in. So this is my T account for retained
2,100.
earnings. What's my ending
Debit.
balance?
2,100 credit.
Or you can just call it out. So Hamza, you say 2,100. James, you say 2,500. Everybody else put in the chat what you think it is. We had credit beginning balance, 2,200. We had, oops, what did I do with it? 2,200 beginning balance. We had 300 credit, and we had 400 debit. What's the ending balance for retained earnings? We're getting different answers. So James, you're adding the 2 debits, 2,200 and 300. And when they're on the opposite side, you need to subtract them, minus 400. Yeah, so the answer is 2,100. So we would take the 2,200, the 300, that would give you 2,500 minus the debit side, and that gives you a credit balance of 2,100. You see it now? Nope, maybe. Stop share. Let's see if I can. There we go. There we go. All right. Okay. So that's the closing entries. So I want to make sure you know how to do those. And then we get to all of these perpetual and periodics. Okay. And I want to see, let's see if I have it. I think I shut it down. Let's see. I want to go back and look at something else on the course pack. Okay. Something that we talk about in class, but we don't always emphasize in online. So let's take a look. Here we go. All right. So there's a problem in your homework and there's a problem in the back, and it talks in the back of the chapter, and it talks about calculating cost of goods sold. Okay. So I tell students, you have to get to this number, goods available for sale. And how do we get there? Well, 5 numbers. Okay. Beginning inventory, plus purchases, plus freight in. We talked about the difference of freight in, freight out last week, minus purchase returns and allowances, and minus purchase discounts. Add those 5 things up and you get goods available for sale. Then you subtract ending inventory, and people have to go out and actually count physical inventory. So beginning inventory plus purchases plus freight minus purchase returns and allowances and minus purchase discounts equals goods available for sale. That gives us what's available for sale. And then it can only go 2 directions from there. Either we sold it or it's still an ending inventory. So how do we know what we sold? We go out and we count ending inventory. And that's why we're subtracting it. We're saying this is still an inventory. So this is what cost of goods sold has to be. Okay. For the journal entries for periodic, we use separate accounts for purchases, purchase returns and allowances, purchase discounts, and freight in. For those same transactions in perpetual, we just use the inventory account. And it's not because we're doing one or the other, it's because we have to do one or the other. It's based on how our computer system works. If it's a modern, fancy computer system where we're barcoding everything at the checkout counter, we know exactly how much inventory we have all the time, and we're perpetually updating our records. If we're like a Bartell's drugstore, we may not track all the inventory that closely. If we're a Home Depot and we have an aisle with nuts and bolts and screws and fasteners, there's no way they're going to track every item. They just do it by a periodic system for that aisle. Maybe for the rest of the store, they have perpetual, but not for that aisle. Okay. So just based on your business. So you guys are going to get a list of accounts you did in the practice exam, and you need to know how to calculate cost of goods sold using periodic system. And of course, for gross margin, sales minus sales returns and allowances minus sales discounts equals net sales. And then for perpetual, we just subtract cost of goods sold and we get gross margin. For periodic, we embed this whole sentence here and this whole calculation here. We still calculate cost of goods sold. We still calculate gross margin. Okay. All right. So know the difference between perpetual and periodic. They're so similar. And what I like is at the back of chapter 5, it does a really nice job. Let's see if I can find them. There's just this side by side, and I have it on my PowerPoint slides as well. Let's take a quick look at that. And yeah, here we go. Yeah, tell me if you guys can see my PowerPoint slides.
Yep.
Okay, awesome. Thank you. All right. So we've got 2 types of transactions. I've got a side-by-side comparison, perpetual versus periodic. For purchases, perpetual versus periodic for sales. So let's look at the purchases, and we'll see these on the practice exam as well. Here's how and this is the transaction that I was just talking about. This is one of those boxes. So we have beginning inventory. Here we have purchase of merchandise. Here we have paying the freight bill. Here we have purchase returns and allowances. And here we have purchase discounts. In the perpetual system, we use merchandise inventory for all of these transactions. In the periodic system, we have 4 separate accounts. They're very temporary accounts, and we will close them out at the end of the period. Okay. But we have to use these because we don't have a computer system that updates everything automatically. We're using a simpler system. Okay. But look at the similarities here. Sure, where the colored accounts are here, they're different. But where it's in black font, they're the same. Okay. You see a lot of accounts payable and cash. Okay. And then if we go forward to the sales transactions, they are identical. Accounts receivable sales, sales returns and allowances, accounts receivable, and so forth. But in the perpetual system, when you sell merchandise or when you process a return, it's 4 accounts. In the periodic system, it's 2. Why? Because in the perpetual system, we're keeping inventory updated for sales. We're keeping inventory updated for returns. In the periodic system, we don't do that. We figure out what's in ending inventory when we take a physical inventory. We figure out cost of goods sold after we subtract ending inventory from goods available for sale. So my challenge to you, my charge to you is when you're reading this, maybe bring a highlighter to the exam. When you're reading this, highlight perpetual or periodic. So you can get your head in the game at the beginning. And remember that it really comes down to perpetual has more in the sales transactions for these 2 journal entries. And perpetual only uses inventory in the purchasing transactions. It's periodic that uses a different accounts. So try to keep that straight. And no, you cannot bring notes to the exam.
On the sorry, I got a quick question on February 14th there on the bottom left. So it's payment on account with discount.
Correct.
So we pay the cash. The cash is a liability, and then the inventory of 25 is a liability.
It's not a liability, it's a credit.
Credit.
Sorry. Inventory is an asset account. So we're saying, what is the cost of this inventory? Well, we originally paid $1,400, right? That was a plus. That increased our inventory cost. Then we had to pay for freight, which also increased our cost of inventory. And then the customer returned some, so that reduced our cost of the inventory. And then the vendor gave us a discount of $25. So that reduced the cost of our inventory. All of those are transactions. If you can visualize the T account, we had 2 debits and 2 credits. And at the end of the day, this inventory cost us what? If you add and subtract those things up, what do you get?
$12.45.
$12.45, which happens to coincide with the cash, right, Hamza? So the final cost of our inventory was 1,2. Oh, that's not right. Hang on. 1,245. Okay. All right. Okay. So they're not liabilities just because we credit them. They are a reduction in the asset cost.
Okay, so that 25, I thought that had a different account title. I don't know why, for the perpetual, but I guess that makes sense.
It's perpetually going into merchandise inventory, and we're perpetually updating cost of goods sold too. So let's go to the sales transactions. Here we're saying we're getting this inventory out of our inventory. We're reducing our inventory because we've sold it. That increases the cost of goods sold and what's the difference between these two? What's the name for that? What's the difference between sales and cost of goods sold called? So we sold it for $1,400.
Net sales?
The cost was at $1,050. What would you call that difference of $350? I think it's $350, yeah.
Gross profit.
Gross profit, good, Zach. So in business, in anything, you want to be able to cover your costs. And remember, going back to that multi-step income statement, we have more costs under this. This is just our gross profit, also called gross margin. We still have to cover our salaries and our rent and all of that stuff. But this gives us that first cushion, that first margin to cover our overhead expenses. Okay.
I have a
So-
question.
Yeah, go ahead, Zach.
This is kind of like off topic from this.
Mhm.
As for the trend analysis that was on the practice, on this practice exam, is it gonna be just like how on last test, it was like the same sort of trend analysis needed as on the practice exam?
So it's going to be the same style of analysis. So you don't
Okay.
have a whole lot of data.
Mhm.
I'm not asking you to know what's going on in, I'm just going to bring this up. Lululemon. I mean, a lot of you do know what has happened in these years at Lululemon, but it's not necessary. I'm saying, look at the revenue. Oh no, this is what I'm saying. Look at earnings per share for Lululemon. Look at gross margin for Lululemon and do that same trend analysis. And you guys have already done it. You turned in a paper a week ago, less than a week ago, that used all this trend analysis. So I'm asking you to do it again. Give me a thesis statement. Was this trend favorable, unfavorable, or neutral? Give me evidence of numeric evidence, which is the net change in the trends year over year, and give me percent change year over year. Okay, just like we did for the project, just like you did for the last exam. So I want you to get out of my class the ability to look at years of data and say, this trend looks great, this trend looks unusual, and just discuss why. So that's my goal. Okay. And we had a little practice here and find the missing numbers, calculating numbers. And I think that was it. Prepare a cost of goods sold system. So there's extra data here. There's extra information. So you need to know what is relevant and what is not. 5 of these numbers, up to 5. There could be possible that there's no balance in one of the numbers. Up to 5 numbers are added up to get to goods available for sale. Then you subtract ending inventory and you get to cost of goods sold. And I'm not, I don't care about format for calculating cost of goods sold because it's just mainly a calculation. And then we just have a few more journal entries. Okay.
I had a question about question 9. Exercise 9.
Hang on. No. Ryan,
It says, yeah, it says watch the dates closely. What do you mean by that? Aren't all the dates the same?
So I put that in because of a good example of that, Hamza, is the question you asked me about, are we booking depreciation for 3 years or 1 year? And then the other big clue is like when I had the depreciation problem, I said, depreciation is booked annually. So that told you that you didn't need to book it for the month, you needed to book it for the whole year. So things like that, which it comes up often with adjusting journal entries. So let's take a look at this. On March 31st of the current year, these are the balances before adjustments. The equipment has a 4-year life. Prepare adjusting journal entries, March 31st, assuming that entries are made quarterly. Okay, that's what I mean by dates, okay? So for depreciation, we know the journal entry is depreciation expense, debit, accumulated depreciation credit. But what's the dollar amount and how do you calculate it? That's when you have to pay attention to the dates.
Oh yeah, that makes sense. I thought you meant the date of the journal entry
No,
when we're posting it.
Alex said they're all going to be March 31st in this example because you're booking the
Mhm.
adjusting journal entries. In the
Alright,
other
yeah,
example, all the dates were going to be December 31st. So,
Thank you.
You bet. And you guys are all able to access the solutions, yes? Has anybody
Yeah,
tried?
we got them.
You got them? Okay. I just want to make sure they release. I have them on a time release, so I'm always nervous that something will happen. Okay. I will see you guys tomorrow. Study a lot. It's a lot of journal entries, so I recognize that. So whatever devices you use to memorize stuff, use them tonight. So,
Thank you.
all right, you guys take care.
Thank you so much.
Alrighty.
Thank
Bye-bye.
you.
Thank you, Professor. Have a great
See you
day.
later.